What you should expect when taking out a loan to buy a business. This one's just a high-level overview. We've got some videos that are pinned that go in a little more depth. And of course, if you need help, we've got a complimentary service if you're doing a deal over $1 million. Now, the first step is to work with your bank. So typically your contact to the bank is going to be the business development officer, or BDO. They're going to review your deal. They're going to look at the marketing info. They're going to look at the profit and loss statements. They're going to look at the tax returns. They're going to look at your resume. They're going to look at your past taxes, your income. They're going to give the deal a initial review. And after this initial review, if everything looks good, they're going to issue what's called a term sheet. Now, term sheets are not all equal. Some banks, the BDOs, actually have the credit committee or the credit officer review the deal before issuing the term sheet. In some instances, the BDO just gives a term sheet that hasn't been looked at by anyone else but the BDO. Sometimes that can be a benefit. You could ask your person you're working with, if you need something quick to help secure a deal, just say like, hey, I need a quick term sheet, a non-credit approved one. And they'll give you one, and it will have like different disclosures than the one that's typically reviewed by credit. So it's a lower level, but the term sheet is just basically the bank has reviewed the deal and they think it's something worth working on. Now, after you receive your term sheet, typically you need to sign it, return it, and you need to make a $5,000 deposit towards deal costs. And once you've made that wire, you're going to go into the next stage, which is underwriting. So underwriting is just where the bank is going to do a much more in-depth analysis of the business. They're going to make sure everything's proved out. So for instance, for the term sheet, the BDO might just take your word on it that the seller is making $100,000 a year. The underwriter is going to want to see the W-2 and the payroll statements. They're going to want everything proved out. So we're just going to go into even more detail with the underwriters. After the underwriter puts together an underwriting packet, they're usually going to take it to credit, whether the bank has a committee or a credit officer. They're going to take it to credit for review, and they're going to provide a approval or non-approval of the deal. And just a side note, we prefer to work with banks that have credit officers versus credit committees. I know this is really kind of inside, but it can make a big difference. Credit committees are tough because you have a group of individuals with, if any one of them has a question, it's going to get kicked back to you. You're going to have to answer the question, then you have to get back in line to get the credit committee again. They're going to find a question, they're going to kick it back to you, you have to get back in line again. And all the group, there's always going to be people that really, ultimately everyone on that committee, their goal is to advance their career. So you're going to have people that are trying to just ask questions because they want to be seen asking questions. And that's going to slow your deal down. So that's why we prefer working with banks where you have a single point of contact, a credit officer, usually a very senior individual. They're usually not trying to impress anyone. They're just trying to figure out if this is a good deal or not. They typically come back with less back and forth, so that's why we prefer that model. So if your deal is approved, similar to the term sheet, you're going to read what's called a commitment letter. So it's very similar to the term sheet. It's going to look pretty similar to the term sheet. It's just a higher level of commitment from the bank. They've done a more in-depth review of the deal, and they're ready to move forward. So once you receive that, you're going to sign it. You're going to have to give another $5,000 towards deal costs. And they're going to move into the third and final stage, closing. Now, I feel like closing is actually really the hard part. This is where they're going to do things like get the titles set up, all the legal, a lot of the details of the transition are going to be worked out. Sometimes when you hear you're going into closing, it sounds like the deal's going to be done right away. That closing period can last a long time. It can last 1 to 2 months. So you're not at the finish line yet. You've still got a lot of work to do, but you're on your way. And the closing process can be really stressful. I feel like it's pretty often we have deals that feel like they're gonna die at some point during the closing stage. We've only had one that actually did. We had a seller back out for no reason the day before the closing. But once you complete all your closing items, you've completed your closing checklist, then it's time for the actual closing. So what's gonna happen there, it's gonna feel pretty similar to taking out a mortgage. You're gonna get a huge stack of documents, usually around 300 pages. You're gonna have to sign a lot of times, but then when you're done, instead of owning a house, and this one, you're gonna own a business. Guess we covered more than I meant to, but I can't help it. I'd still check out those pin videos if you want a little more detail.